Options pinning theory is probably one of the most interesting and also secretive ways that you can choose your strike price. And if you get this right, you can make between about 95 to 100% profit within just 1 week. Welcome back to Everything Options. My name is Greg, and today we're going to be talking about the options pinning theory. So to break this video down for you, first I'm going to go over the basics and how this works and why it works. And then finally, at the end of this video, I'm going to show you an actual example with how to use this theory. But before we get into it, if you want to see more videos like this on advanced option strategies and theories, make sure to leave a like down below and comment what you want to see next. Option pinning theory suggests with a big asterisk mark that the stock and its price will gravitate towards its most popular strike price. And you're probably wondering, well, how the hell do I choose the most popular strike price? And it's actually pretty simple. You're going to look for open interest, or the number of contracts that are currently being held open on a specific option with a specific strike price and a specific expiration date. To find the open interest using Robinhood, what you're going to do is go to any option. You're going to look underneath the limit price, the bid-ask spread, click on the arrow to the right, and then towards the bottom, you're going to see open interest. It's going to be on the second row from the top, and for this one, it is 75,786. So there's 75,786 people that are holding this SPY $440 call option expiring at 9/17. Now this isn't going to be the most popular one, and I'll show you how to figure that out later, but if you're using a different brokerage, it's pretty much the same concept. You're going to find the option with the highest open interest, and this is going to boil down to a specific option with a specific strike price and a specific expiration date. The best expiration date whenever you're using this theory is going to be the monthly expiration date, and this is going to be on the third Friday of every single month. This is the one that most people are going to be trading because historically monthly options have been around a lot longer than weekly options, since weekly options have only been around since about 2005, whereas monthly options have been around since about 1973. A little history lesson for you there. This means that people that have been trading options for a while have become very accustomed to these monthly expiration dates, and that's where the highest open interest is going to be because of that. So there's going to be more people trading this, there's going to be more liquidity, which is going to make it easier to get in and out of your trades. Sometimes though, whenever you're trading options on less popular stocks, it can be pretty hard to get in and out of your trade. Even if you're using monthly options, if the volume on that stock on the shares is under 1 million, generally that's not going to be the stock to use. So for stocks that are trading under an average of 1 million shares per day, I wouldn't touch them with the 10-foot pole using this strategy at least. And this is because you're usually going to use multiple options whenever you're using this theory, which is going to make it incrementally harder to get in and out of your trades. So with this in mind, you want to choose stocks with high liquidity and high average trading volume. So you want to pick stocks that have over 1 million shares traded per day, and these are going to be pretty easy to get in and out of. One stock that everybody knows about that is extremely popular is GME, especially when it comes to options because the volatility for GME is through the roof. You're going to see a lot more volatility and you're going to get a lot more premium by using this theory with GME than you would with SPY. I was actually planning to use this theory on GME this week with their earnings report coming out earlier in the week, and I actually would have been completely right about this because I was expecting it to trade completely flat, but I got spooked off by the volatility. If you're a fan of roller coasters, skydiving, and thrills, then GME is probably a good stock for you. But for me, I'm just your average Joe Schmo, and I like to use this strategy on SPY, as boring as it sounds. I found some pretty good consistency over the last few months by using this theory with SPY. And the entire reason why this theory even works is that market makers are actually incentivized to push a stock and its stock price close to the most popular strike price on the expiration date for those options. And you can argue about the market maker's role in the market and the ethics behind it all you want, but they're really the ones that are in charge. They're also the ones that stole about $150 from me last week by opening up the wrong trade, so if you're a market maker and you're watching this, I'd like my money back. All jokes aside, the entire reason why they push a stock to be at that specific stock price is a little bit cynical. Market makers assume that the options with the highest open interest are mostly long positions, people buying into those options, so they want those people to lose money. That way they get to collect all the premium that they got from selling those options to those buyers. It's a bit screwed up, I know, but this is why you'll also hear this theory called maximum pain theory, which they're trying to inflict maximum amount of damage that they can by making sure that these options expire completely worthless, they get to keep all the money, and the buyers lose all their money. And this is also why you want to be on the receiving end of premiums rather than forking up your own money to buy into these most popular options. You're going to be selling options instead of buying them. That way, you're just like the market maker. You get to collect all that premium while the buyers lose all their money. If you're short on an option and that option expires worthless, you're not going to have to pay any sort of debit in order to close your trade. So if you got $100 of credit to open your trade and the option is going for $0 at the expiration date, you don't have to pay anything to close it, so you get to collect the entire $100 of credit. The buyer, on the other hand, who pay you that $100 in credit as a debit to them is going to lose that $100 in its entirety because that money is going to you. It's not personal, we're just trying to make money out here, right? And if you want to know which options that market makers are targeting, there's this nice little website that you can use. It's called maximum-pain.com. This is going to show you the max pain graph for any stock that you want. So it's going to show you the exact strike price that you need in order to use this theory. Again, you're going to choose the monthly expiration date or the third Friday of every month. So for this month, we're in September right now, the third Friday would be 9/17. So you're going to select this. So if we wanted to play GME this week using the options pinning theory, we would go with the $200 strike price, which is where the max pain point is. But how do you use this theory in practice? Well, before we get into the actual example, if you want to see what options I'm trading every single day, I post all my trade alerts to my premium Discord. You can find that in my Patreon, which is going to be linked down in the pinned comment below. Now I'm going to use this theory and this strategy on SPY. And I know it's not going to be nearly as sexy as using it on GME. I'm not going to get the same amount of premiums, but you can apply this theory and this strategy across pretty much any stock with high trading volumes. So to start using this theory in practice, I'm going to go to maxpain.com and I'm going to search for SPY at the top. I'm going to set my expiration date to 9/17, which is the monthly expiration date, the third Friday. I'm going to scroll down to the max pain graph, which is going to be right in the middle here. And the max pain point for this month is going to be at the $437 strike price. This means that the highest open interest for both calls and put options is going to be at the $437 strike price. This means market makers are going to push for the stock to be at this $437 strike price on 9/17. So with this in mind, we're going to create a strategy with the 437 strike price on 9/17. So we're going to make sure to sell these options. We're going to scroll down to the $437 strike price, and then we're going to sell this 437 call. This means that we're agreeing to sell 100 shares of SPY at $437. Right now, SPY is going for $445. So if it doesn't move at all, we would take a $800 loss based on the shares. But since we're receiving $1,046 of credit, we would actually come away with about a $200 gain. If SPY was above $447.46 when this option expires though, then we would be at a loss. This is going to be our break-even price, and anything above that, we're going to take a loss. Anything below that, we're going to take a profit. And if SPY falls all the way down past $437 by the end of the week for this option, we're going to get to collect that entire $1,046 of credit. On the other hand, we could also sell a put option with the strike price. So we're going to cancel this option, and then we're going to go to the put option chain. And then we're going to scroll down to the $437 strike price. This one is going for $219. So we're going to get $219 of credit for opening one of these. And here we're agreeing to buy 100 shares of SPY at $437 if it's below that on our expiration date on 9/17. If it's above $437 on our expiration date, then we're off the hook. We don't have to buy 100 shares of the stock, and we get to keep the full $219 of credit. And if it's below $437, then we're going to have to buy 100 shares of SPY at $437 for $43,700 total, and that's how much collateral you have to put down for your trade. So if you don't have $43,700 to put on this trade, then you can't open it, unfortunately. But another way that you can use this strategy without having to put a crap ton of money down is credit spreads. So for this, what we would do is we could choose to sell put options against this. So we would sell the same $437 strike price. We're going to click select on the top right, and then we're going to sell the 437, and then we're going to buy a 436 for a little bit cheaper. And for this, we're going to get paid $16 of credit, and we're only having to put down $100 of collateral since the difference between our strike prices is only $1. And if we want to add to this and get even more premium, because $16 isn't a whole lot, to be honest, we could sell call options as well. So what we would do is sell the 437 call, and then would buy the 438 call, And for all these 4 options, we're going to get paid $130 of credit. That's actually wider than the spread for each of the option types, which means that we actually wouldn't take a loss in this case. The expected minimum profit, which is actually supposed to be the max loss in this case, is actually positive $30. So you would make $30 no matter what. And then if SPY was exactly at your $437 strike price where the market makers want this to be, you get to collect the full $130 of credit as your max profit. Now these options are probably kind of wonky because this was the closing price on a Friday where the volume was pretty extreme, and the spread for these is probably extremely wide whenever it comes to the bid-ask spread for these options. So this isn't going to be entirely accurate. If I were to guess, this trade should be going for around maybe $105 or $110 of credit instead of $130. But this still means that you would come away with a profit even if you're totally wrong, even if SPY isn't near $437 on your expiration date. But don't get it twisted. You're actually still taking on a lot of risk whenever you open these options. And the risk whenever you're opening these options is exercising. So if SPY is actually at around $437 on your expiration date and you hold those options into the expiration at 8 p.m. on your expiration date, you might be on the hook to either buy or sell 100 shares of SPY at your short strike prices at the 437 strike price. And if you don't have the money to cover that, or if you don't have the shares to cover that, then you're kind of in trouble. So the name of the game here, always close your spreads before they expire. It's usually in your best interest. Something else to keep in mind whenever you use this strategy in the options pinning theory is that the maximum pain point can actually change during the week. If SPY starts to go up, maybe the max pain point can shift upward, or if SPY continues to fall, the max pain point will shift downward. The maximum pain point will usually follow wherever the market is heading. So what you can do in order to mitigate this is open this in the later half of the week, maybe Wednesday, Thursday, or Friday, rather than opening it on Monday or Tuesday. That way you have more certainty on where the stock is going to be at the end of the week. But the problem with this is that if you open it towards the later half of the week, you're not going to get as much premium. So you're not going to get as much profit whenever you're opening it towards the later half of the week than if you were to do this in the beginning half of the week. This is kind of a double-edged sword, and I know this is a lot to take in, so if you have to watch this video a couple times through, go ahead and do that. And if you have any questions for me, leave them down in the comments below. My DMs are open on Discord as well. You have a ton of ways to reach me. Thanks for making it all the way to the end of this video, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.